Thank you very much, Jochen. It's not going to be an educational speech. I want you to enjoy this speech, to take some information. It's pretty late, so I think it's going to be fun for all of us. And as you know, my speech is called In Gold We Trust. I see there are a few gold bucks remaining. And I've read a great quote by Bernard Baruch, who was one of the greatest speculators back in the days. And he said, we have to break the continuity of bearish thought. To break the continuity of bearish thought. Let that sink in. This is something that can only be achieved by rising prices. And I will give you some ideas how we might see rising prices going forward. Let me start with a thank you not only to the Michaels family for organizing such a wonderful event, to Jochen for always wearing the best pair of pants. This year in green, that's a good sign for the gold market. But also to our premium partners of the report. Some of you know this In Gold We Trust report. It's 250 pages. It's produced once a year. We've got some great people in our team for the project of this, for the big project, writing this gold report. There are 15 people involved, and as you know, it costs quite a lot of money. Crunching the numbers, researching, doing the layout, doing the charts, proofreading, translating, and so on. And we couldn't do that without our premium partners. Some of them are in the room. For example, McEwen Mining, of course. There's Tudor Gold, and there's Victoria Gold. So thank you very much for supporting us. When I started writing this report 12 years ago, I said, okay, I want to produce a benchmark report that is highly respected in the industry. I think we're very close to getting there. The last report was downloaded 1.7 million times. And we are very proud to announce that next year we will publish the report in Chinese as well. So there will be a Mandarin version. And basically, a friend of mine from Vienna, he said, in Viennese accent, well, you know, there are quite a lot of people in China and they all love the gold, so produce the gold report in Chinese. And I thought, well, that's pretty good business reasoning, and that's why we're starting the gold report in Chinese next year, and I hope that we can really do something for the industry, because I think there's lots of gloom and doom research out there. So what we really want to do is produce high quality research that also resonates with institutional players. We want to make the case for gold in a very serious way. So thank you very much for supporting us. What am I going to talk about in the next 3 to 4 hours? Well, we're going to talk about the status quo. Where is gold? Where are the markets in general? We're going to talk about the turn in the monetary policy. We are moving from a quantitative easing environment to a quantitative tightening environment. So the liquidity party in financial markets is officially over, but many people have not recognized that. Then we could talk about the turn of the tide in the global monetary architecture, de-dollarization. That's a long process, and we're in the middle of that process. We're going to talk about gold stocks and a conclusion, Quo Vadis Aurum. Let's start with the status quo. Where are we? A great quote that resonates very much with the general market sentiment at the moment. The illusion is summed up in the phrase, the new era. During every preceding period of stock speculation and subsequent collapse, business conditions have been discussed in the same unrealistic fashion as in recent years. There has been the same widespread idea that in some miraculous way, the fundamental conditions and requirements of progress and prosperity have changed. Well, perhaps some of you have read that quote. It was published in the Business Week on November 2nd, 1929. So perhaps things are not different this time. We all know what happened in fall 1929, and we know what happened in the 30s. Teddy Roosevelt devalued the dollar and revalued gold from 20 to 35. And we know that one of the main reasons of the Great Depression, of this deflationary period, was the Roaring '20s. We have seen massive inflation in the '20s, and that was the cause for a huge bull market in the United States. So the Great Depression was actually only the consequence of the preceding inflationary period. And ladies and gentlemen, I think I told you last year already that life is all about expectations. We have seen it with Apple announcing results quite recently, and the results actually were pretty good, but the expectations were extremely high. We know that 80% of all the wins in the S&P 500 this year came only from 3 stocks. So the market is actually, the market breadth is very, very weak. The expectations to the technology sector, on the technology sector and their results is extremely high. And therefore, we have to think about our expectations. We have to manage expectations. You know this chart or this picture from last year. This nice guy, he's probably gonna kill this guy because of this tattoo, but I've got an update. Expectation. So, we have to know our expectations and we have to manage those expectations. Why am I talking about expectations? Because Adrian Day, an analyst that I respect very, very much, he said a couple of months ago in an interview that people are expecting too much from gold. What did he mean? Well, back then when he did the interview, expectations were probably too high on gold because the equity markets were still rallying. We've seen all-time lows in volatility. We've seen real estate was rallying. Bonds were trading close to all-time highs. Trust in financial system and in banks was back. We've seen very low price inflation. The Fed was raising rates and implementing QT. And cryptocurrencies were stealing the show from gold. So this was, per definition, an environment where, as an investor, you don't really need too much gold. But actually that has changed in the last couple of weeks. Stock markets were rolling over, volatility climbed significantly. We are seeing that bonds are actually struggling. And one key point, ladies and gentlemen, we have seen in the correction in October that stocks were falling and bonds were falling. So bond yields were rising. And normally in a balanced or in a conservative portfolio, you've got the stocks and you've got bonds. And normally when stocks fall, you've got this negative correlation. So bonds should preserve you, should hedge you. This time, this did not happen. So with all the risk parity funds that try to squeeze out some yields out of the market, they will get into serious trouble if this negative correlation should not hold up. And the question is, what's going to be the safe haven then? Is it going to be Bitcoin? Is it going to be real estate? Perhaps it's going to be gold. Low price inflation, also not there anymore. We're seeing actually that in the US, we're seeing massive problems with wage inflation, especially for skilled workers. And cryptocurrencies are not really stealing the show anymore. Basically, there's no volatility in Bitcoin, which is pretty interesting. But it's not a point that people discuss at cocktail parties anymore because it's, many people have burned their fingers. So real estate is still doing quite okay. although we're already seeing cracks in the US housing market because, of course, mortgage rates rose significantly, the trust in the financial system and banks is still pretty okay, I would say. And the Fed is raising rates and is implementing quantitative tightening. So those are the three remaining factors from my point of view, but the rest of those factors, pretty bearish factors, they are out of the market for a couple of weeks now. And people were expecting too much from gold. Okay, it depends where you're living. If you're living in Turkey or in Venezuela, gold actually perfectly did its job. It preserved your purchasing power. It saved you from monetary inflation and from price inflation. So actually, gold did exactly what it's supposed to do. Now, let's have a look at this table where we're seeing the annual performance data in different currencies. Now, everybody is thinking gold is dead. Gold doesn't perform at all. Well, actually, I would say gold is doing quite okay. In euro terms, it's down 0.5% since the beginning of the year. Of course, we're seeing a massive dollar bull market, but in dollar terms, it's down 5%, but gold was up 13.6% last year. It's not that bad. Gold is up in Canadian, is it Aussie dollars? It's up in Chinese yuan terms. So actually, I would say it's a mixed situation, but gold is performing in some currencies, and of course, everybody is looking at gold in dollar terms, but we're seeing massive strength in the US dollar this term. But we all know my yuan is smaller. No way, my buck is smaller. Basically, what we're entering, and Donald Trump started this trade war. The Chinese are answering the trade war with a currency war. The Chinese devalued the renminbi by 11% since March, which of course puts pressure on the US. It puts pressure on commodity markets. But we should not forget, Donald Trump just recently said the Fed is crazy. Steve Mnuchin, he criticized the Federal Reserve. Donald Trump often said that interest rates are way too high. He even complained like a little child, like a little baby, saying, but Obama had 0 interest rates. That's not fair that the Federal Reserve is raising rates. So actually, Donald Trump is scared because the US dollar is too strong. Donald Trump wants and he needs a weak US dollar. Actually, the whole world probably will need a weak US dollar. So from my point of view, he will try everything to get the dollar weaker, and at some point, he's gonna succeed. Let's talk about the markets in general. We had the chart last year already. It's produced by Deutsche Bank. It's an aggregated index for bonds, nominal yields, and equities. And you can see that we're seeing the highest valuation for bonds and equities since the year 1800, at least. Now, equities are not that overvalued, we have to say, especially some sectors. Some sectors are extremely overvalued, but the general stock market is not that overvalued. But the bond market definitely is. And we also know that this chart is basically the inverse of the rates chart. So low rates, high valuations, makes sense. But in an environment of rising rates, those valuations will probably get a problem because opportunity costs are rising. Now, this reminds me again of our friends. I think you remember them. My friends sitting in the pool, having a couple of beers, and then after 5 or 6 beers, somebody says, okay, well, we should start barbecue. And then one guy comes up with this electrical grill, electrical barbecue. Then there's the line. Then if the got the extension, then they've got the floating slippers, and then they just fix it. Now, why am I bringing up this picture? I was attending a conference a while ago, and I was talking to some asset managers, large institutional players, and we talked about markets. And we said, okay, yeah, markets are pretty expensive. We know they're pretty dependent on central bank actions. We know that central banks printed 20 trillion of liquidity out of thin air, and everybody said, yeah, we know that it's expensive, but we have to stay in the market. We have to stay in the game. But we will go out of the market before the market crashes. Okay, well, that's in theory, that sounds pretty smart. But in practice, it normally doesn't work because you see, okay, this is perhaps a small market dip, a small correction. I'll stay in the market or even double up. But they probably won't get out of the pool early enough. And that's the general sentiment when you talk to institutional investors. They have to stay in the game because of career risk, because they've got very high targets to reach, and so on. So a general advice, perhaps, sometimes in life it makes sense to step back, to think, is it really a good idea to do stuff like that? And rethink it. And I've got some other examples from a beautiful webpage called the Darwin Awards. Well, have a look at this guy. He is really scared. Not a good idea. There's a reason why women live longer than men, probably. Also, this guy, I mean, I don't know if you can see it. That's really stupidity in one picture. You cannot make this stuff up. Yeah, that's gonna hurt. And my friends, wow. So, ladies and gentlemen, the message is sometimes you have to be a bit contrarian, to not stay in the pool, to rethink if it really makes sense, to be in the market, to participate in that kind of stuff, and perhaps it often makes sense to have some insurance, at least. And we already saw that chart. It's actually one of the most quoted charts that we ever produced. That is the anti-bubble. We're seeing the S&P GSCI Commodity Index versus the S&P. You know that, you have seen it already. And we're seeing that over here, we are at the lowest level since 1971. Now, normally markets over the long term tend to mean revert. And if we would mean revert, that's a pretty big move. As you can see, I think it's interesting that those lows also coincided with tops in the US dollar. So the US dollar would have to roll over to make that go up. And that's another kind of version of this chart. That's a long-term trend line since 1971 for the S&P GSCI Commodity Index again. And as you can see, that's a very broad uptrend line. But the market, as I've said, it tends to mean revert. And for commodities to come up to this long-term trend line, they would have to rise by 104%. For equities, if they would go back to this long-term trend line, they would have to fall 37%. I mean, that sounds really outlandish to most people, but that's just how markets work. Mean reversion is one of the fundamental laws of investing. So, what could be a trigger for such a development? It could be that actually central bankers are taking away the punch bowl. Franz Lischke, an Austrian friend of mine, he said people vastly underestimated the power of QE and they are in danger of doing the same with QT. So basically the 20 trillion that were created by central banks out of thin air, of course they had an effect. They had an effect on asset price inflation. They had some effect on price inflation. Of course, they avoided a deflationary collapse, but we have to make sure that everybody understands that this reduction of liquidity will have effects as well. So it's the Federal Reserve that actually started with quantitative tightening. They very, very slowly started with this tightening, with reducing the amount of liquidity, with reducing the balance sheet of the Federal Reserve. But since October, they're reducing the balance sheet by 50 billion per month. So this year, the balance sheet will be reduced by 420 billion. Next year by 600 billion, and 2020 by 600 billion as well. That's quite a lot of money. And it's not only the Federal Reserve that is becoming more restrictive, more hawkish. It's even the ECB, of course, with a huge time lag. It's even the Bank of Japan that is considering to get out of quantitative easing mode. So the message is, central banks are taking away the punch ball. They are taking away the safety net from markets. And that's a very, very important message. And it's not only quantitative tightening, it's also rising rates. So, I don't know, I grew up with those fabulous Bud Spencer and Terence Hill movies. Some of you probably have seen them. And Bud Spencer always gives this Stereowatschen, as it's called in Vienna. That's like the double whammy, a double slap. And for markets, quantitative tightening and rising interest rates might be such a double whammy. What you can see here on this chart is the rate cycle since 1914. And you can see that out of 19 recessions, 16 recessions were in an environment of rising interest rates. Every financial panic was preceded by rising interest rates. So, of course, we're still at very, very low levels. But I think as we have seen zero interest rates for such a long time, markets and market players, they became addicted to low or even negative rates. So, at this level, we're already seeing in the mortgage market, for example, in the United States, that many players are getting in trouble. So the longer that gets, and the Federal Reserve is supposed to do one more rate hike this year and 3 or even 4 rate hikes next year, sooner or later, there's going to be a big problem appearing. And the Federal Reserve is always a bit late at the party, but the European Central Bank is even later at this party. So normally in the course of a recession, interest rates are lowered by 500 basis points. ECB is still basically at zero. So what's the ECB gonna do if recession fears are coming up? I really don't know what they're gonna do, but I think it will have to be something really dramatic, because you're seeing this law of declining marginal utility. So the next round of quantitative easing will probably be significantly higher than QE for the third round of QE, which was 85 billion. So we know that the debt situation in the US is actually not developing so well. Somebody said what Donald Trump is doing, that's a Keynesian wet dream, because actually the economy is going full steam. We've got record employment, full employment, and still they're running a deficit of 1.2 trillion this year. The debt situation was doubled in the last decade, and for the next decade, it is expected by the Congressional Budget Office that the total further debt in the US will be 13.2 trillion. Now, the CBO is very conservative, and they say in the next 10 years, there won't be a recession in the US. So they are expecting 13.2 trillion, but only under the circumstance that there is no recession in the US in the next 10 years. So if there's a recession, from my point of view, that's very likely, and the recession is something normal, something that you shouldn't fear because it's just a reallocation of resources. It's actually something really healthy for the capital structure. If a recession happens, probably the further deficit will be significantly higher. And now we're coming to the third point, the turning of the global monetary architecture. Some of you might have heard of this very renowned international gold analyst. His name is Mr. T. It's not me after the summer vacation. So Mr. T said, I believe in the golden rule, the man with the gold rules. And he's actually quite right. Jim Rickards, who's on our advisory board, he always says that if you want to play poker with the big guys, you have to bring poker chips. And those poker chips are actually golden. So you're seeing in the United States, they still got 8,100 tons. I know there's lots of rumors and stories about that. I think the US still holds those 8,000 tons. The Eurozone actually holds more than 10,000 tons of gold. Russia is buying every month. They've got close to 2,000 tons at the moment. Their monetary, I think M2 is backed by almost 50% with their gold reserves. China is officially having 1,800 tons, probably significantly more. And so you can see that actually the big guys that play a role, they own quite a lot of gold. But it's not only the developed markets, it is also the rest of the world that is accumulating gold at the moment. And we have seen those numbers coming out from the World Gold Council. Poland, for the first time in ages, was buying gold, the Polish Central Bank. The Hungarian Central Bank was buying gold. We've seen Kazakhstan, we've seen Kyrgyzstan buying gold. So actually, the gold reserve of emerging markets are still pretty low. It's like 3%, while for developed countries, it's 19%. So Kenneth Rogoff came out 2 or 3 years ago, and he openly said that emerging markets should buy significantly more gold to diversify out of the US dollar. And this de-dollarization is actually a very, very big and very important topic. We're seeing basically on a daily basis that emerging market countries are having contracts where they basically circumvent the US dollar, where they are settling their trades in local currency and not in the US dollar. So this is happening. And actually, I think this was really, really outstanding. I couldn't believe that number. It's provided by GAVCAL. You know that the so-called Petro Yuan was launched basically in March. So the Chinese have got their Shanghai Oil Exchange now, and you can trade oil now in Chinese yuan. And as you know, oil is by far the biggest commodity market in the world. And the Chinese already got 14% market share. 14% market share only after 6 months trading. So that's really significant, and that's definitely a sign for this de-dollarization that is happening and that is picking up momentum at the moment. Gold mining stocks. Well, what should I say? It's tough. Lost quite a lot of hair trying to manage gold mining stocks. But I think there are signs that it's getting better. Russell Napier, one of the best strategists that I know, he said, the great financial success stories are people who had cash to buy at the bottom. Well, let's have a look at valuations on a relative basis. What you can see here is gold mining stocks, so the gold bucks index versus the S&P 500. On this ratio, you can see that actually we're at the same levels like in 2016, beginning of 2016, and when this big bull market in mining stocks started. And when the big bull market started, mining stocks were up 1,300%. quite a nice performance. But for the last bigger bull market that started at the same valuation level, where actually gold was up, I think, $270, but mining stocks were up 174%. So they have shown you what kind of leverage they can provide from a very, very oversold level. They were up 174%. That's pretty decent performance. So from my point of view, if we can break this continuity of bearish thought, if gold can go at 1350, 1370, where there's those major resistances, I think that's going to be the moment when institutional players that are on the sideline at the moment, when they will enter the market again, because we have seen in the last correction in October, actually gold was doing pretty well. Gold was really holding up. It was a great portfolio hedge. And actually mining stocks were not selling off in the course of this correction. So that's a very encouraging sign. And we have seen this chart, just an explanation or a comparison of bull markets. We know that the last big bear market in mining stocks was the longest and most brutal when it comes to the drawdown in history of mining stocks. So normally a bull market is the mirror image of the preceding bear market. So this is just a kindergarten party, yeah? That's nothing. And perhaps I shouldn't say kindergarten party because I've got 3 kids, and if you ever go to a kindergarten party, there's really something going on. It's perhaps more of a party in the nursery home, something like that. But we haven't seen anything yet. And we can all see at the end of every trend, and we are far away from that, there's this mania phase. Now, it could be very, very easy in theory. When everybody is greedy and buying, when the sentiment is extremely positive, then you should sell. And then at the bottom, when everybody is really fearful and is selling, then you should buy. But normally people do it quite the opposite way, and then they repeat it until they're broke. So from my point of view, when it comes to sentiment, we have seen in the mining stocks, but also in gold, some of the most negative and some of the most bearish sentiment readings in 30 years. We have seen a good commitment of traders report. So I think the starting point is pretty good. We're coming to the conclusion. Brent Johnson, he said, the risk of owning gold is of not owning gold is greater than the risk of owning gold. And from my point of view, if you say that a recession might happen, and we've shown this chart in the last gold report again, the 58 most respected analysts on Wall Street surveyed by Bloomberg, what they're expecting for the next 3 years. How many out of those 58 are expecting a recession in the next 3 years? 0. Nobody. So the market is not positioned for a recession. We have crunched the numbers. How does gold perform in the course of a recession? Actually, pretty well. On average, up 20%. So if you expect a recession, gold should be a pretty good hedge. Gold is also a pretty good hedge in equity bear markets. In local currency, in 2008, gold did really, really well. It was up 6% in dollar terms, while the S&P was down 38%. In other currencies, it was up even more. So if you want a really good hedge, a really stable hedge for market turmoil, gold is doing a pretty good job. We're also seeing that the gold-silver ratio is at an extreme. Normally, we crunch numbers again, normally that's a pretty good entry point because extremes in the gold-silver ratio are a good entry point for gold and even more so for silver. So if gold really should pick up momentum, silver should pick up even more momentum. And the fact that the gold-silver ratio is that high, I think that also shows you that it's not the inflation trade at the moment, that it's more of a deflationary trade that is happening. And yeah, already coming to the conclusion, I think the macro picture is getting better. I think we're seeing the signs of the consequences of the rising rates and of quantitative tightening. I think we're seeing that this change from a quantitative easing to quantitative tightening environment will have significant consequences for financial markets because we got so used to this environment of liquidity, 20 trillion that were pumped into the market. I think that central banks and governments, they actually have to become really, really innovative, creative in the course of the next recession. I think they will enter. I think there's from my point of view, there's no doubt that there will be another rounds of quantitative easing. In Japan, for example, we're having already 11 rounds of quantitative easing. So that's going to happen, but it will be significantly bigger. The de-dollarization is picking up momentum. I think following the Chinese renminbi to the US dollar is really, really important. That's from a macro point of view, something that should be followed. And mining stocks have posted the most negative sentiment readings in 30 years. We have seen some capitulation selling, and from my point of view, for the longer term, it offers a very, very skewed risk-reward profile. So, I would like to end on a bit more personal note, because last year, actually, 1 year ago, I was sitting here on a table with a fine gentleman called Paul Burton. And we all know that Paul died of cancer, unfortunately. And before my presentation, I was pretty nervous. And he said, Ronnie, enjoy what you're doing. Enjoy what you're doing up on stage. Enjoy every second. And I think that's a very good advice for us all, to enjoy the moment, to enjoy every second. Paul was a great guy, and I think we should all be very, very thankful. So thank you very much for taking the time. I hope you enjoyed it, and I think there's still some time for Q&A. Thank you very much.